In a world where, let's face it, basic savings offer pretty minimal returns, um, many of us find ourselves wondering how to truly make sense of the vast, sometimes overwhelming world of finance and investment.
It really is huge, isn't it?
Yeah. Beyond just your everyday bank account, where do you even begin to understand the real opportunities out there?
Yeah.
Especially when all the jargon seems to build this, like, impenetrable wall.
It does feel like that sometimes. The financial media constantly throws terms at us, equities, money markets, and it can certainly feel like you need a finance degree just to keep up.
Exactly. Well, that's sort of our mission today. We're cutting through that noise to take a deep dive into what are often called other direct investments.
Right.
Our goal is to quickly and clearly unpack what these investments are, how they really work, and maybe most importantly, what specific factors influence them, moving well beyond those, basic financial assets you might already know.
And we've pulled together a collection of sources that lay out the fundamentals, investing in everything from company shares, different types of property, even those crucial short-term money market instruments.
So the idea is to give you a comprehensive but genuinely digestible understanding.
That's the plan, to make it accessible.
Think of this deep dive as your ultimate shortcut. Our aim is to provide you with those essential nuggets of knowledge, helping you become well-informed about diverse investment opportunities, all without that familiar feeling of, well, information overload. So let's unpack this.
Okay, let's start with what are arguably the most important type of security issued by UK companies. Equities, often known as ordinary shares.
Okay.
These are bought by, well, everyone really. Private individuals, massive institutions like pension funds. Essentially, when you buy a share, you're buying a small piece of that company.
Okay, so if I own a slice of that company, what does that really mean for me? As an individual investor, what are the core rights that ownership actually gives me?
That's a crucial question. As an ordinary shareholder, you typically have two fundamental rights. First, you get to receive a share of the company's distributed profits. We call those dividends.
Right, dividend.
And second, just as important, you get to participate in key company decisions by voting at shareholders' meetings.
Okay. You mentioned securities as the sort of fundamental building block. Can you elaborate on that term and how they're categorized? You mentioned ownership like equities and debt like gilts and corporate bonds.
Sure. Securities are simply financial assets. They broadly divide into ownership instruments, i.e. the equities we're talking about now,
Got it.
and debt instruments, things like government gilts or corporate bonds, where you're essentially lending money.
And then what exactly is a dividend and why does the amount change?
Right. So a dividend is just a portion of a company's profits that it decides to distribute to its shareholders. The amount depends heavily on, well, how profitable the company is, obviously, and also how much it needs to reinvest back into the business for future growth. So a company that's really focused on rapid expansion might pay smaller dividends, choosing to plow profits back in instead.
That makes perfect sense. I imagine while shares of the same class generally have similar characteristics, the specific rights can sometimes differ a bit.
They can, yes.
And what about the inherent risk? We hear a lot about risk.
Absolutely. The specific rights can differ based on a company's articles of association, so it's always worth checking the details.
Yeah.
And yes, a direct investment in shares definitely carries a higher risk profile than, say, a savings account.
Okay.
This includes the potential, however small for some companies, for the company to fail entirely, which could mean losing all of your capital. That's why it's generally seen as a growth investment, not capital preservation.
Right. And here's where it gets really interesting for me. Share prices. They aren't static, are they? What are the real forces driving those daily fluctuations we see? Beyond the headlines, what are the key factors making them jump or dip? Our sources seem to point to 4 key drivers.
That's right. The first, and perhaps the most obvious one, is company profitability. A healthy, growing company that consistently delivers strong earnings, well, that usually translates to a more attractive share price. Makes sense, right?
Yeah, logical.
Then there's the broader economic principle of supply and demand, not just for those specific shares, but also for other competing investments. High demand for a limited number of shares will naturally push prices up.
Okay, supply and demand. And the third factor, something about the sector.
Exactly, the strength of the specific market sector itself. A booming tech sector, for instance, might lift all tech stocks, even companies that aren't, stellar performers on their own. A rising tide lifts all boats, sort of.
Gotcha. And finally, the big picture.
The big picture, yes. The strength of the overall UK and global economy. A strong economy tends to boost investor confidence across the board, which often leads to broader market rallies.
So it's a mix of company-specific stuff and wider market forces.
Precisely. And while those short-term fluctuations can indeed be spectacular and grab all the headlines,
They certainly do.
our sources consistently highlight a really foundational truth. For the long-term investor, equity-linked investments have historically been the most powerful engine for wealth creation. They've consistently outpaced inflation and delivered higher growth than simple deposits over the long run.
So the deep dive insight here is maybe. Don't let the noise of short-term volatility distract you from that long game potential.
That's a great way to put it. Focus on the long game.
Okay, so now that we understand what shares are and sort of what influences their price, let's talk about where these pieces of ownership actually change hands. You mentioned the London Stock Exchange, the LSE, is the main hub in the UK.
That's right, the LSE.
Can you help us understand the different marketplaces within it, especially the difference between the primary and secondary markets?
Absolutely. The LSE effectively operates two main markets for shares. First, you have the main market. Companies listed here face pretty rigorous scrutiny.
Okay. High standards.
Very high standards. They demand high levels of transparency from financial regulators. Think of it as the premier league for established companies. It's designed to offer a very high level of investor protection through these robust disclosure requirements. You need, for example, at least 25% of your share capital in public hands for 3 years.
Right. And then there's the alternative investment market, AIM. That sounds a bit more dynamic. Maybe for newer companies.
It is, exactly. AIM is specifically designed for newer, smaller companies that have significant growth potential. It offers less rigorous rules.
Easier to get lifted.
Much easier, yeah. It makes it easier for these companies to access public finance, broaden their audience of investors, and enhance their overall profile. It's often seen as a crucial stepping stone for, burgeoning businesses.
Okay. And that distinction between primary and secondary markets, what does that actually mean for someone looking to buy or sell shares?
Good question. The primary market is where companies raise new finance. They do this by selling securities for the very first time.
Like going public.
Exactly. That's what we mean when a company goes public or has its flotation. The secondary market, by contrast, is where investors buy and sell existing securities shares that have already been issued.
That's where most trading happens.
Oh, yes. This secondary market is vastly larger in volume. It's where most everyday trading occurs between investors.
With so much activity, how do we even begin to measure the overall performance of these massive markets? What are the key sort of barometers investors look at?
That's where share indices come in. They essentially measure the overall performance of shares by tracking the price movements of a representative basket of stocks.
Like FTSE.
Exactly. In the UK, the main ones are the FTSE 100 index, commonly known as the FTSE. That tracks the top 100 UK companies by market capitalization.
Right.
Then there's the FTSE 250 index, which tracks the next 250 largest companies. And the FTSE 350, which just combines the 100 and the 250.
And there's an even broader one, the all-share.
Indeed. The FTSE All-Share Index. It includes around 600 shares split into various sectors. It measures price movements, yields, and total returns across a much wider spectrum of the market.
You mentioned market capitalization there. Can you just quickly define that?
Sure. Market capitalization, or market cap, is simply the total market value of a company. You calculate it by multiplying the total number of shares the company has issued by the current share price. It's basically a quick way to understand how big a company is in market terms.
Got it. So who are the big players in these markets? It's not just individual investors like me clicking buy, right?
No, far from it. While individuals are certainly involved, the main participants are really diverse. You have huge institutional investors, think pension funds, life assurance companies managing vast pools of capital.
Right, big money.
Big money. Then there are commercial banks and other traders, governments, public institutions, corporations raising capital, and of course investment banks who help companies issue new securities and handle complex trades.
And I think our sources mentioned over-the-counter trading and something called dark pools. That sounds a bit sinister.
It does sound mysterious, doesn't it? Over-the-counter, or OTC, trading just means trading done directly between two parties, away from a formal exchange. It's common, especially among institutions trading large blocks of securities.
Okay, so what are the dark pools then?
Right, dark pools are essentially private exchanges or trading venues. The key thing is that large orders are matched and executed there without being publicly displayed until after the trade is complete.
Ah, okay. Why would they do that?
Well, the main reason big players use them is to avoid impacting the public market price with their large trades. Imagine a pension fund wanting to buy millions of shares in a company. If they place that huge order on the public exchange, it could cause the price to jump significantly before they finish buying, making their purchase much more expensive.
Right, they'd move the market against themselves.
Exactly. Dark pools allow them to execute these large trades with minimal price disruption. It's about getting the deal done efficiently without spooking the market.
That's fascinating. Okay, let's talk about returns and risk. We know shareholders have limited liability. They aren't personally on the hook for the company's debts.
Correct. A key protection.
But that doesn't mean it's without significant risk, does it?
Absolutely not. While limited liability is a huge protection, you can't lose more than you invested, there's always the potential to lose all your capital if the company goes into liquidation or its value just plummets.
Right.
However, it's also true that equity investments generally aim for, and over the longer term, have historically delivered higher returns than more secure deposit-based investments. It's that fundamental trade-off, higher potential reward for taking on higher risk.
That makes sense. But how do dividends actually work in practice when you own shares? It seems a bit more complex than just getting a payment. What's this talk of ex-dividend dates?
Ah, yes, the mechanics. Dividends are usually paid half-yearly, sometimes quarterly. A key concept here is the ex-dividend or XD date. Think of it like a cutoff point.
Okay.
If you buy shares on or after this specific date, you won't receive the next upcoming dividend payment. That payment will go to the person who sold you the shares, the previous owner.
Oh, okay. So timing matters.
Timing is crucial if you're focused on income. Conversely, if a share is trading cum dividend or CD, that means if you buy it, you will receive the next dividend payment.
And does that affect the share price around that date?
It typically does. The share price is generally expected to fall by approximately the amount of the dividend on the morning it goes ex-dividend. This reflects the fact that the right to that immediate cash payment has now been detached from the share.
Interesting. So what does this all mean for assessing how well an investment is doing, or maybe trying to predict its future performance? What are the key measures investors and analysts actually use?
Good question. There are two main forms of financial returns from shares, right? You've got the growth in share price, that's capital growth.
Right.
And you've got the dividends you receive, that's income. To assess success and try to predict future performance, we look at several key measures. One is earnings per share, or EPS.
EPS, yeah, I've heard that one.
It's simply the company's net profit divided by the total number of ordinary shares it has in issue. It tells you, quite literally, how much profit the company is making for each share.
Okay, straightforward enough. And then there's dividend cover. How does that help us understand things?
Dividend cover tells us how comfortably a company can afford to pay its dividends out of its profits. For example, a cover of 2.0 means the company's earnings are twice the amount it's paying out in dividends. So 50% of profits are distributed and 50% are kept back by the company.
So a higher number is safer, generally.
Generally, yes. A cover significantly above 1.0 indicates that a company is retaining some profits. This can be a good sign for funding future growth, and it provides a cushion the company could likely withstand a drop in profits without having to cut its dividends straight away.
Right. And the price-earnings ratio, the PE ratio, that's a term you hear constantly. What's the real insight there, beyond just the calculation?
The PE ratio is simply the current share price divided by the earnings per share, EPS. It's a very common metric, and it's useful as a rough guide to a share's growth prospects, and especially for comparing companies within the same market sector.
But what does a high or low PE actually tell you?
Well, here's the potentially counterintuitive insight about the PE ratio. While a very high PE might make a stock seem expensive or overpriced,
Yeah, that's what I think.
it often signals that the market is actually pricing in expectations of really strong future growth. Investors are willing to pay a premium now because they believe earnings will rise significantly later.
So it's about future expectations, not just current earnings.
Exactly. It's less about current value and more about investor conviction in that company's potential. So if you see a high PE, don't just dismiss it. Dig deeper. It could be a sign of a true growth powerhouse, not necessarily a red flag indicating it's overvalued right now.
That's a really useful perspective.
Okay.
Let's quickly touch on taxation. Always important. How are returns from shares typically taxed here in the UK?
Right. Tax. Dividend income first. It's subject to a dividend allowance, a certain amount you can receive tax-free each year. Tax only applies to amounts you receive above this allowance, and the rate depends on your individual income tax band.
Okay, so there's an allowance. What about when you sell shares for a profit?
That's capital gains tax, or CGT. It applies to the gains you make when you sell shares, or other assets for that matter. However, like dividends, you have an annual exempt amount for capital gains too. You only pay CGT on gains above this annual allowance.
Got it. Allowances for both income and gains. Okay, so moving beyond just ordinary shares, companies have other ways to raise capital and offer different kinds of investments. Let's start with rights issues. What are they, and why is it crucial for existing shareholders to pay attention?
Rights issues are a way for companies already listed on the stock market to raise further capital. They do this by giving their existing shareholders the right, but not the obligation, it's important to note, to buy new shares, usually at a discount to the current market price.
Okay, a discount sounds good. Why is it crucial to pay attention?
It's crucial because if you don't take up your rights, either by buying the new shares or sometimes selling the rights themselves, your existing shareholding gets diluted.
Diluted, meaning?
Meaning your percentage ownership in the company decreases because the company has issued more shares overall. Even though you still hold the same number of shares, they represent a smaller slice of the bigger pie. So you generally need to take up the rights or sell them if possible to avoid that dilution effect.
Right, okay. And scrip issues. These sound like bonus shares, almost too good to be true sometimes.
They kind of are in a way. Scrip issues, also sometimes called bonus issues or capitalization issues, involve shareholders receiving additional free shares in proportion to their existing holding.
Free shares? How does that work?
Think of it like slicing a pizza into more pieces without actually making the pizza itself any bigger. You get more slices, more shares, but each slice is proportionally smaller. So the theoretical value of your overall holding generally stays the same immediately after the issue. The share price adjusts downwards to reflect the larger number of shares.
So why do companies do it?
It's often a way for companies to reward shareholders without actually draining their cash reserves to pay a cash dividend. They're essentially turning some of the company's internal reserves into new shares and distributing them.
Okay. So if ordinary shares are the most common, what are preference shares? And who might find them appealing?
Preference shares are a different beast from ordinary shares. They typically pay a fixed-rate dividend, sort of like a bond, and crucially, this dividend must be paid before any dividends are paid to ordinary shareholders.
So they get paid first.
Yes, they have preference, hence the name. Many are also cumulative, which means if the company can't afford to pay the preference dividend one year, the unpaid amount accrues and must be paid out in the future before ordinary shareholders get anything.
What about voting rights?
Usually they don't have voting rights. However, they often gain voting rights if their dividends are delayed for a certain period. They also typically have a higher claim on the company's assets than ordinary shareholders if the company is wound up in liquidation.
So who buys them?
They tend to appeal to investors who are looking for a more predictable income stream, perhaps with slightly less risk than ordinary shares, but they generally offer less potential for capital growth compared to ordinary shares.
And convertible preference shares. That sounds like they offer some flexibility, maybe.
Exactly. These have an embedded option. They allow the holder the right to convert their preference shares into ordinary shares at a specified ratio and date in the future.
Why would you want that?
Well, it gives you the stability of the fixed preference dividend initially, but also the potential to participate in the company's future capital growth if the ordinary shares do well. Because of this conversion option, they often offer a slightly lower fixed-rate dividend than a comparable non-convertible preference share or a corporate bond.
It's like having your cake and eating it too, potentially.
Potentially, yes. A hybrid approach.
Okay, finally in this section, warrants. What do these offer an investor, and what's the core decision point when you're holding one?
Warrants give the holder the right, again, not the obligation to buy a company's ordinary shares at a fixed price, the exercise price, at an agreed future date or during a specific period.
How are they different from just buying the share?
They typically cost only a fraction of the price of the actual shares themselves. This offers a leveraged play on the share price. If the share price rises significantly above the exercise price, the warrant's value can increase dramatically.
Leverage, okay. So what's the catch? Or the decision point?
The core decision point is simple. It's only worth exercising the warrant, buying the shares at the fixed price, if the actual market share price is above the warrant's exercise price at the time you can exercise it. If the share price is below the exercise price, the warrant is effectively worthless, and you just let it expire, losing only the initial amount you paid for the warrant itself.
Got it. High risk, potentially high reward depends entirely on the share price movement.
Precisely.
Okay, let's switch gears now. We've talked a lot about company securities, which can feel a bit abstract. Let's move to something much more tangible. Property.
Bricks and mortar.
Exactly. We mostly think of residential property as a home, but it's also a huge investment vehicle. What are the core appeals and maybe some of the often overlooked pitfalls?
You're right. While most people own their homes to live in, a growing number buy residential property specifically as an investment. One key benefit is that property can often be used as security for borrowing purposes, which can help finance further investments.
And the UK market.
The UK property market is generally seen as highly developed and relatively efficient, with lots of data and established processes for buying and selling.
But it's certainly not a guaranteed win, is it? What are the key pitfalls people need to be aware of?
Definitely not guaranteed. Property is highly sensitive to location, so the old location, location, location mantra is absolutely true. Badly sited developments can be problematic.
Okay.
It's also very susceptible to broader economic conditions, particularly things like interest rate changes, which affect mortgage costs. And perhaps one of the biggest differences compared to shares, it's a much less liquid investment.
Less liquid meaning harder to sell quickly.
Exactly. It's much harder and slower to sell property and convert it into cash compared to selling shares on an exchange. And don't forget the significant upfront costs like stamp duty land tax on purchase. Plus, any rental income you get is subject to income tax, though certain capital expenditures might be offset against eventual capital gains tax when you sell.
Buy-to-let property has been in the spotlight a lot recently, especially with some tax changes impacting landlords. What makes it attractive on the one hand, and what are the key risks potential investors absolutely must understand?
Buy-to-let has several potential attractions. For investors, it can offer the prospect of regular rental income, which might increase over time, potentially acting as a hedge against inflation.
Okay.
There's also generally easy access to ancillary services like property management agents if you don't want to manage it yourself, and relatively easy access to mortgages specifically designed for buy-to-let. Plus, as we said, it's a well-developed market with clear legal frameworks.
So what's the catch then? Especially thinking about those recent tax changes and just the practical realities.
The risks are significant, and maybe sometimes underestimated. Accessing the market can be difficult because of the high initial investment cost, the deposit, legal fees, stamp duty, land tax, which is often higher for second properties.
Right, it's not cheap to get started.
Not at all. And again, it's illiquid. It might be hard to access your capital quickly if you need it. Then there are void periods, times when the property is empty between tenants, meaning no income, but you still have costs like mortgage payments.
That sounds stressful.
It can be. There's also the risk of tenant damage, potential disputes, and legal fees if you have unsatisfactory tenants. Plus, and this is crucial, it requires ongoing active management and maintenance. Even if you use an agent, you're still ultimately responsible. It's not a passive investment in the way owning some shares might be.
And the government concerns you mentioned?
Yes, recent government policy has reflected concerns that the rapid growth of the buy-to-let sector might be reducing the availability of affordable housing for first-time buyers, leading to tax changes designed to, well, cool the market a bit.
Okay, moving away from residential, let's talk about commercial property. What exactly falls into this rather expansive category? And why might an investor choose it over, say, a buy-to-let flat?
Commercial property is a really broad category. It covers almost anything that's not wholly residential. So think individual retail units, entire shopping centers, office blocks, industrial units like workshops or factories or warehouses, hotels, leisure facilities like gyms or cinemas, and even mixed-use properties that combine commercial and residential elements.
A lot of variety there. Why choose it?
An investor might choose commercial property for several reasons. It often has the potential for higher rental income or yield compared to residential. Capital growth tends to be steadier, perhaps less spectacular, but more predictable.
Yep.
Tenants are often businesses on longer leases, maybe 10, 15, 25 years, which can mean more stability compared to shorter residential tenancies. Rent reviews are also usually built into these leases, often every 5 years, allowing for predictable income adjustments, typically upwards linked to market rates or inflation.
Sounds good, but what are the downsides? Commercial properties are often much bigger investments, right? So I imagine that brings challenges.
Indeed. The average value of a commercial property is typically significantly higher than a residential one. This makes risk diversification much harder. You might be putting a very large chunk of your capital into a single asset, a single building.
Right. All your eggs in one basket.
Pretty much. Also, commercial property doesn't generally show the spectacular capital growth sometimes seen in residential property, especially during housing booms. And if you're funding the purchase with borrowing, you might face higher interest rates than for residential mortgages.
Any other complexities?
Yes, lenders perform much more extensive due diligence before lending on commercial property. They'll look closely at the quality of the land, the reputation of the builder, and crucially, the financial stability and suitability of the proposed tenant. This adds complexity and time to the acquisition process.
Okay. Our sources also mention a bit of a niche category, agricultural property or farmland. What's the unique appeal here? It seems quite specialized.
It is very specialized, yes. Distinct from residential or commercial, its unique benefit, and often the primary reason people invest in it beyond just farming, lies in its potential inheritance tax relief.
Inheritance tax, how does that work?
Under current rules, agricultural property can qualify for significant relief. It can be up to 100% relief from inheritance tax for owner-occupied working farms and potentially 50% for tenanted farmland, subject to various conditions being met.
That sounds like a major tax advantage.
It can be, yes. However, as you noted, it's a very specialized market. Finding buyers or sellers can be challenging, and liquidity, being able to sell it quickly when you want to, can be a significant concern compared to other property types or shares.
Right, a niche play with specific tax benefits but liquidity challenges. Okay, finally, let's wrap up with money market instruments. These sound quite different. Again, short-term financial tools for very specific purposes. What's their core function?
They are quite different. Money market instruments are essentially forms of short-term debt. A key feature is that interest is typically not paid out periodically during the term. Instead, they're usually issued at a discount to their face value, or par value.
So the return is built in.
Exactly. The return for the investor is the difference between the discounted price they pay initially and the full face value they get back when the instrument matures. Their core function is really for large organizations, companies, financial institutions, governments to manage their short-term cash flows. It's a way to park surplus funds securely and earn a small return for very brief periods, maybe days or weeks or a few months.
And the main types we should know about.
We'll look quickly at three main types: Treasury bills, certificates of deposit, CDs, and commercial paper.
Okay, let's start with Treasury bills. The name suggests government involvement, so presumably very secure.
Extremely secure. Treasury bills, or T-bills, are short-term redeemable securities issued by the UK Treasury's Debt Management Office, the DMO. They're like government bonds or gilts, but with much shorter terms.
How short?
Typically issued for 91 days, so about 3 months, though other short terms exist. As we just mentioned, they are zero coupon securities. They don't pay interest directly. You buy them at a discount, say. You pay £9,950 for a bill that will mature at £10,000 in 91 days. That £50 difference is your return.
And the security aspect.
They are considered to have virtually zero default risk because the borrower is the UK government. The minimum investment is typically quite high, maybe £10,000 or more, sometimes much more. So they are largely used by big organizations to manage their short-term surplus cash very safely.
Okay. What about certificates of deposit, or CDs? How do they differ? And what's this unique thing about them being bearer securities?
CDs are issued by banks and building societies, not the government. They offer a fixed rate of interest for a specified period, typically a bit longer than T-bills, maybe 3 to 6 months, sometimes longer.
Fixed rate, okay.
Yes, you know the return you'll get. Deposit amounts are usually quite high again, often £50,000 or significantly more. And there can be penalties if you need to withdraw the money early, so they're less flexible than just putting money in a standard savings account, especially for smaller sums.
And the bearer security part.
Ah, yes, that's quite interesting and increasingly rare these days. Many CDs are bearer securities, which means, quite literally, whoever physically holds the paper certificate owns the deposit and the right to the repayment.
Like holding cash.
Exactly like holding a high-value banknote. Possession confers ownership. This makes them potentially very easy to transfer. If you can find a buyer in the secondary market, you just hand over the certificate. But it also carries unique risks. If the physical document is lost, stolen, or destroyed, proving ownership can be extremely difficult, if not impossible.
Wow, okay. Handle with care. And lastly, commercial paper. What's its role and who typically uses it?
Commercial paper is essentially a short-term IOU, an unsecured promissory note, issued directly by large companies to borrow money.
Unsecured. So riskier than T-bills.
Yes, definitely riskier than T-bills because The borrower is a company, not the government. The risk depends entirely on the creditworthiness of the issuing company. They use it to borrow for various short-term needs, like funding inventory, payroll, or other working capital requirements.
And who buys this?
Transactions are typically for very large amounts, often millions, so the buyers are usually institutional investors like pension funds, insurance companies, money market mutual funds.
How short-term are we talking?
Very short. Maturity periods usually range between 5 and 45 days, with the average being around 35 days. Often, companies will roll over their commercial paper as one issue matures. They issue new paper to replace it, effectively retaining the funds for longer periods, but repricing the interest rate frequently.
What are the advantages for the companies issuing it?
The main advantages are flexibility. They can raise funds quickly as needed, and the fact that the interest rate they pay isn't fixed for a long period. This can be cheaper than bank loans sometimes, especially for highly rated companies, and beneficial if they think interest rates might fall.
Right, flexibility and potentially lower cost. Okay, wow, what a journey through these other direct investments. We've really covered a lot of ground. We've unpacked everything from the ownership rights and, the dynamic market forces behind equities
Here's the shares.
to the tangible benefits and potential pitfalls of investing in residential, commercial, and even that niche agricultural property.
Right, the bricks and mortar side.
And finally, diving into that quick, efficient world of money market instruments like T-bills and commercial paper.
It's quite a diverse landscape, isn't it? Each of these areas, equities, property, money markets, presents its own really unique set of risks, potential returns, and let's be honest, complexities.
Absolutely.
Understanding these different types of direct investments is, I think, incredibly crucial for anyone looking to just interpret financial news intelligently, or maybe to make more informed decisions about their own capital, regardless of what their personal investment goals might be. It helps you see beyond just the headlines and grasp the fundamental drivers at play.
I agree. It gives you a much better framework. So considering this diverse range of direct investment options we've just unpacked, from the potential volatility of shares to the very real tangibility of property and the relative stability of short-term money market instruments, here's a thought to leave you with. What criteria would you prioritize when evaluating an investment? How would you find something that truly aligns with your personal financial risk tolerance and your own long-term aspirations?
That's the key question, isn't it? Matching the investment to the individual.
Definitely something to ponder until our next deep dive.